Ben Graham starts Chapter 4 with a plain fact. Your portfolio should be shaped by who you are, not by what's going on in the market. If you're a savings bank or a legal trust, your world is high-quality bonds and maybe a little preferred stock. If you're a wealthy, experienced businessman, you might hunt bargains anywhere. The sensible middle is the defensive investor, someone who wants safety, low hassle, and decent returns without becoming a full-time securities detective. Here's Graham's big practical idea. Your target return shouldn't be set by how much risk you can take, strictly speaking. Instead, aim the return level at how much intelligent effort you're willing to put in. If you want a passive life, expect modest returns and build a safe, simple portfolio. If you want to work at it, you can reasonably aim higher. That said, Graham lays out clear, conservative guardrails for the defensive investor. First, limits. He says never less than 25% and never more than 75% of your portfolio should be in common stocks. For most defensive investors, he recommends a simple, almost boring default: 50% stocks and 50% bonds. Why so plain? Because it's easy to follow and it prevents the common human error piling into stocks as everything goes up and panicking out when things fall. Graham even gives a mechanical rebalance rule. If stocks rise to 55% of your assets, sell 1/11 of your stock holdings and move the cash to bonds. If stocks fall to 45%, use 1/11 of your bond fund to buy stocks. It's not glamorous, but it enforces discipline. Graham recognizes institutions don't always follow their own formulas. Yale, for example, drifted from a conservative 35% stock target to over 60% by the late 1960s. That shows how market euphoria can infect even experienced managers. So the 50-50 rule is partly defensive psychology. It stops you from getting carried away. Now the bond side. Graham walks through the trade-offs investors face: taxable versus tax-free, and short versus long maturity. Which you choose should be arithmetic plus common sense. In early 1972, for instance, high-grade corporate bonds yielded about 7.5% for long maturities, while prime municipal bonds yielded about 5.3%. If your marginal tax rate is high, the municipal tax exemption can make them the better after-tax choice. If you can hold bonds in a tax-sheltered account, taxable bonds can make sense there instead. He also explains the maturity trade-off. Long bonds pay more, but they fall more when interest rates rise. Shorter bonds are steadier but pay less. For most defensive investors, he leans toward intermediate-term bonds, the middle ground, because guessing interest rates is a losing game for most folks. A concrete favorite in Graham's toolkit is the United States Savings Bond. He praises Series E and Series H bonds for their combination of safety, government backing, and useful features, like the option to defer federal tax on Series E until redemption or to extend earlier issues. For modest savers, these are simple, no-fuss fixes worth considering. Graham also warns strongly about lower-grade, high-yield junk bonds and many fancy structures. They may offer higher yield, but the individual risk and probability of default are simply too high for a defensive portfolio. He prefers high-quality issues, and he flags callable bonds as a subtle trap. Decades ago, a company could issue a high-coupon bond, watch rates fall, and then call the bond at a tiny premium, robbing you of the upside. He suggests paying a little less yield for long, non-callable protection when you can. Preferred stocks are a hybrid investment, combining features of both stocks and bonds that give shareholders priority over common stockholders for dividends and company assets in case of liquidation. They typically pay fixed dividends, are less volatile than common stocks, but generally offer little to no voting rights and limited capital appreciation potential. Investors often buy them for a steady income stream. They're a mixed bag, according to Graham. They can look attractive for yield, but legally, they sit awkwardly between bondholders and common shareholders. No interest deduction for the issuer, and dividend payments can be skipped. Graham's take: only buy preferred stocks when they're cheap enough to be bargains, and even then they're often more suitable for aggressive investors than for the defensive type. A critical and refreshing point: Graham does not tie your stock allocation to your age. He criticizes the old 100 minus your age rule. Instead, he says your allocation should be driven by your actual life situation and temperament. Ask yourself, do you need the money within 5 years? Do you have a steady salary, a mortgage, kids' tuition coming? Do you handle emotional stress well during market plunges? If you need cash for living expenses or you know you'll panic at big drawdowns, lean heavily into bonds. If you truly have long horizons, spare cash, and steadiness, you can tilt towards stocks. But still within that 25 to 75% band, Graham prescribes. He offers practical behavioral advice too. Rebalancing is not just technical pedantry. It's how you enforce the buy low, sell high discipline. For most people, rebalance every 6 months, no more and no less. Set your target split and stick to it unless your life circumstances change. That prevents you from buying high out of FOMO or selling low out of fear. Finally, Graham's test for whether someone could sensibly go to 100% stocks is illuminating. You need a year's worth of living expenses in safe cash, at least 20 years of steady savings ahead, and the emotional resilience demonstrated by having survived a big bear market without bailing. Most people fail at one or more of those tests, so Graham discourages the all-or-nothing approach. To wrap up, Chapter 4 is a pragmatic playbook for the defensive investor. It says, in effect, be honest about who you are. Use simple rules. Keep stocks between 25 and 75%, favor a sensible 50-50 default, pick high-quality bonds tailored to your tax and cash needs, avoid exotic yield traps, and rebalance on a schedule. Temperament matters more than age, and discipline beats prediction. If you follow those simple guards and resist the seductive noise of markets, you'll have a portfolio that sleeps well at night and delivers reasonable results over time.